I'm going to bet that you can remember in the not too distant past that you would have had the occasion to step into an old office tower. I'm going to say one that was built maybe in the 80s. And one of the things that you'll notice about those buildings is how slow the elevators are, how they kind of shake a little bit on the way up. And places like that just feel tired, right? They're past their prime. And the truth is that there are a ton of that type of building out there these days in major cities across North America. And I'm telling you this because that is where commercial real estate is at right now. It is aging. It is under pressure. And we're not talking about just the property owners that are affected. We're talking about things that affect us all: banks, pension funds, and the markets that we all invest at. When you look beneath the regular economic reports that we get out every month, there is a story, and it's unfolding right now: commercial real estate, CRE. I want to look at some of the numbers there because it is a big crack in the system that could affect us all in the next little while. Now, I want to start in the US. We see office vacancy rates in major US cities at record highs. In Q1 2025, the national average hit 20.4, and that's going in the wrong direction. That is up from 19.8 in Q1 2024. You probably guessed that rising vacancy rates isn't good for a number of reasons. I'm going to cover those off in just a few minutes here. Now, another big problem, there is a wall of transitional real estate debt that is set to mature over the next couple of years. Data firm TREP, this is one of the industry's largest commercially available databases of securitized mortgages, and they estimate that $1.2 trillion in CRE loans are going to be reaching maturity starting last year, moving through 2025, then another 1.8 trillion to follow in 2026 through to 2028. The Mortgage Bankers Association last month, they said refinancing risks are front and center. The maturity wall here is front loaded, so are the associated risks. And then we have the regional banks, which are already under some pressure. We've seen a bit of a pullback in KRE. This is an ETF that tracks regional banks. Who can forget just a couple of short years ago, we had those spectacular failures of Silicon Valley Bank, Signature Bank, First Republic Bank. The Federal Reserve here, it is noted that small regional banks hold over 70% of outstanding CRE debt. So that doesn't give me a huge level of comfort when I look at a potential wrinkle, a potential problem in that space. Just last month now, we have news that Brookfield, this is one of the world's largest real estate managers, they delayed payment on an $885 million leveraged loan as they say they are waiting until the market stabilizes. And keep in mind, in situations like this, we're talking about Class A buildings. We're not talking about junk. We're not talking about sort of some forgotten suburban mall. Even these Class A buildings today can't draw enough rents to help keep up with the rising interest payments. And this gets us to a huge problem. There is a growing sense that CRE is becoming uninsurable for banks. When an office building loses its tenants, the landlord loses cash flow. The building then also needs to refinance at today's interest rates instead of the bargains that they could have locked in just a few years ago. So suddenly that loan becomes a problem for the lender, not just for the owner. That's exactly what we're seeing happening out there today. According to TREP, delinquency rates for office loans are now rising at the fastest pace since 2009, just hitting 10.28% in April. And it's more than just these old offices that are being affected. We're seeing industrial, lodging, multifamily, and offices all heading in the wrong direction. So far, retail, the purple line on this chart, is holding out, but one can only imagine how long that is going to last. Now, I want to move on to why this all matters so much, but first I would like to thank Harvest ETFs for supporting this video. We're talking a lot about market uncertainty in this video, whether that is sector-specific risk like commercial real estate, whether it's just volatility in general, that has a lot of investors looking for stability without giving up on the long-term growth. And that is where the Harvest Low Volatility Canadian Equity ETF, HVOL is the ticker, comes in. HVOL, this fund is built for resilience. It focuses on long-term capital growth by investing in 40 high-quality Canadian companies selected through a disciplined, rules-based strategy that prioritizes lower volatility. So it is designed to smooth out the ride, especially when the markets get bumpy. Now, for investors who are looking to generate extra monthly income on top of that stability, there's HVOI. This is the Harvest Low Volatility Canadian Equity Income ETF. And this builds on HVOL's core strategy, but it adds an active option overlay to deliver enhanced cash flow every single month. Both of these funds aim to limit exposure to market shocks, to reduce individual stock risk, and to provide a more comfortable investing experience, especially for those who are approaching retirement or anyone who just wants to sleep better at night when they're investing. Now, in unpredictable times like this, Confidence does matter. You can learn more about HVOL and HVOI at harvestetfs.com and see how lower volatility doesn't mean lower potential. Okay, so I've covered a lot of facts, but why should we care so much? You should care so much because this isn't a story that is isolated just to property. It's actually a financial system story. It is a systemic risk. And I think of just the banks. They're required to hold reserves. So if the value of their CRE loans drops, or if those loans default kind of in a worst case scenario, then banks either have to raise capital or they have to tighten their lending. And that will mean fewer loans for small businesses. It means stricter mortgage terms. By definition, that will translate to slower economic growth. And just in case you think this is a US problem, you can think again on that. We are seeing very similar trends here in Canada. In Toronto, office vacancy rates are at 18%. That is the green line on this chart here. Just a few years ago, that line was sitting at around 10%. In Calgary, the overall downtown vacancy rate is even higher, sitting at 27%. It's as high as 37% in some Class C buildings. So you take that, you add in current interest rates, you add in regulatory uncertainty, and you've got a sector that looks an awful lot like its US counterpart. So this is not isolated to south of the border. In fact, in its latest financial system review, the Bank of Canada flagged CRE as one of the top areas of risks. The bank collaborated with the IMF and its Financial Sector Assessment Program, and in the risk scenario review, it highlights high rates of credit losses and includes commercial real estate loans, which may also suffer significant losses. And there is another thing that probably matters most to everybody who's watching this video. A lot of pension funds, a lot of insurance companies hold commercial property as one of their core asset classes. And according to a 2024 OECD pension markets report, pension funds in Canada hold around 11% of their portfolios in commercial real estate. And this has always made sense because it was seen as a stable sector. It was seen as being inflation protected. But when we see appraisers start to write down the values or when tenants start disappearing, those whole models are going to break down and it creates sort of a cascading effect. You're going to see lower building values that can lead to lower municipal tax revenue, budget cuts. You'll see higher defaults. That puts more pressure on the banks. That could mean less lending. And then, of course, you get tight credit. That means less growth and more layoffs. It is all intrinsically connected. So where does this all leave us as we sit here today? Where do we go from here? Well, I've highlighted three options here. First of all, the governments could step in with targeted support. Politically, that's a little bit tricky. I'm not sure that anybody wants sort of bailout for big office towers to be a top priority. So less likely we're going to see action there. Second option is that the banks just slowly start to write down their CRA exposure over time. That's a likely scenario, but that does then mean, of course, a slow grind on credit growth, a slow grind on investor confidence. And then option three is that investors just sort of reprice the entire sector. Then we get a messy correction. In fact, we saw in that Mortgage Banker Association report just a bit earlier, it doesn't rule out a 40% correction. So that means lower building values. It means lower REIT prices for those of you who are in that space, and also potentially tighter bank rules. Now, here's an interesting twist to this problem. The commercial real estate market, it doesn't tend to crash like we see in stocks. It sort of grinds away slowly, quietly, one default at a time. And in real estate terms, I look at it like there's termites eating away at the foundation. And by the time that you clue in and you actually see the damage, it's already been happening for months, perhaps even longer than that. Now, you may be wondering, what about me? I don't own office towers. I don't own REITs. Why should I care? Well, here are a few very good reasons that you probably should care. First off, your bank. Your bank is going to care. They have exposure there. That might affect you. Secondly, your pension fund. That might care. If you own an ETF or a REIT in this space, you would care there. And without question, the economy definitely cares. It's about how leverage, how falling demand, higher rates can combine to actually shake what is a key pillar of our financial system. So what is the right move to make here? Do you think that regulators should step in early and cushion the fallout, or should the markets just work themselves out, even if that means we have to go through some short-term pain? Let me know what your thoughts are in the comment. Click on the link here to catch up on some other news stories or to subscribe to our Pulse newsletter. As always, thank you so much for watching, and we'll see you again in the next video.